Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Shopify Inc. Annual Report. Shopify Inc. offers a wide range of services and tools for businesses of various sizes across the globe. The company's primary offering is the Shopify platform, which enables merchants to manage their products and inventory, process orders and payments, and fulfill and ship orders. This comprehensive platform also allows merchants to build customer relationships, source products, leverage analytics, and access financing. In addition to the Shopify platform, the company provides several other services, including Shopify Payments, a fully integrated payment processing service that enables merchants to accept and process payment cards online and offline. The company also offers themes and apps for sale, shipping labels through Shopify Shipping, point-of-sale hardware, and advertising on the Shopify App Store. Furthermore, Shopify Inc. provides shop campaigns for buyer acquisitions and registration of domain names. These services cater to various aspects of a business's operations, from marketing and sales to logistics and infrastructure. With its extensive range of offerings, Shopify Inc. has established itself as a leading commerce technology company, supporting businesses across Canada, the United States, Europe, and other regions. Unfortunately, I don't have access to the text you provided. However, I can still provide a general overview essay on what might cause Shopify Inc.'s stock price to drop. Shopify Inc.'s stock price has been subject to fluctuations in recent years, and several factors could contribute to its decline. One possible reason is the company's increasing competition from other e-commerce platforms such as Amazon and BigCommerce. As more businesses shift their online presence to these platforms, Shopify may struggle to maintain its market share. Another factor that could impact Shopify's stock price is the economic downturn caused by the COVID-19 pandemic. With many countries experiencing recession or slow growth, consumers may reduce their spending on non-essential items, affecting e-commerce sales and subsequently impacting Shopify's revenue. Additionally, regulatory changes and increased scrutiny of e-commerce companies' business practices could also contribute to a decline in Shopify's stock price. As governments and regulatory bodies continue to monitor the industry, companies like Shopify may face increased costs and compliance burdens, potentially affecting their profitability. Lastly, Shopify's high valuation and growth expectations may also be contributing factors to its declining stock price. If the company fails to meet investor expectations for growth and revenue expansion, its stock price could suffer as a result. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. Shopify's primary drivers of revenue growth can be attributed to several key areas. Subscription solutions have been a significant contributor, with an 18% increase in 2024 compared to 2023. Merchant solutions have also played a crucial role, with a 68% increase in 2024 compared to 2023. The growth of Shopify Payments has also been a major driver, as it continues to capture a larger share of total revenue. Acquisitions and investments have further contributed to revenue growth through the integration of new technologies and capabilities. Unbilled revenues have increased significantly, indicating strong demand for Shopify services. Additionally, research and development expenses have generally increased over time, driving revenue growth through the development of new technologies and capabilities. On the other hand, some specific drivers of revenue decline include the sale of logistics businesses in 2023, which resulted in a decline in revenue. An impairment loss was also recognized on the sale of Shopify's logistics businesses in 2023. Furthermore, a decrease in the long-term portion of deferred revenue contributed to revenue decline. Overall, Shopify's revenue growth has been driven by a combination of factors, including subscription solutions, merchant solutions, Shopify Payments, acquisitions and investments, unbilled revenues, and research and development expenses. The net income of the company underwent a significant fluctuation between 2023 and 2025. In 2024, it increased by a staggering 833% compared to 2023, but this trend was short-lived as it decreased by 39% in 2025. The overall decrease in net income from 2024 to 2025 was even more pronounced at 32%. This decline is attributed to various factors, including the difficulty of predicting future revenue growth and expenses. The profit margins also experienced a downward trend during this period. After decreasing by 42% in 2024 compared to 2023, they increased slightly by 1.5% in the same year. However, this marginal gain was short-lived, as they decreased by 3.9% in 2025 compared to 2024. The significant decrease in profit margins between 2024 and 2025 is likely due to the substantial decline in net income during this period. The reasons behind these changes are multifaceted and include increased costs associated with acquiring new merchants, potential undetected errors or defects in software or hardware, compliance with complex laws and regulations, and difficulty predicting future revenue growth and expenses. These challenges have put pressure on the company's bottom line, resulting in a decline in net income and profit margins. The company's financial performance indicates a positive trend in its operating cash flow. According to the data provided on page 56 and page 57, the net cash provided by operating activities has consistently increased over the years. In 2025, the company generated $2 billion in cash from operating activities, resulting in an increase of $1.9 billion in total net assets. This significant growth in operating cash flow is a result of the company's ability to generate positive operating income adjusted for non-cash items. As stated on page 57, this operating income is a source of cash flow, contributing to the overall improvement in the company's financial position. The data also shows that the net cash provided by operating activities has increased from $1.616 billion in 2024 to $2.033 million in 2025, indicating a positive trend. Overall, the company's ability to generate positive operating cash flow is a testament to its strong financial management and operational efficiency. This trend suggests that the company is well-positioned to continue generating cash from its core operations, which will likely have a positive impact on its future performance. The company's debt level has undergone significant changes in recent years. Initially, the long-term debt stood at a substantial $918 million, comprised of convertible senior notes. However, this figure dropped to zero by the end of the reporting period. The total debt also mirrored this change, remaining at $0 with no variation. Furthermore, as of December 31, 2025, the company's debt level was nil, marking a considerable decrease from its previous value. In terms of interest expenses, there has been minimal fluctuation. For the years ended December 31, 2024 and 2025, interest expenses remained relatively stable at $3 million. This stability suggests that despite the significant reduction in debt levels, the company's interest expenses have not undergone a substantial change. The performance of various regions and segments has been a topic of concern for businesses. Poor performance was observed in new and developing markets, international sales, and merchants operating in these areas. Rapidly changing industries also posed significant challenges, with international operations being particularly costly and time-consuming. Latin America, while stable, struggled with low revenue. Canada and the Asia-Pacific region, APAC, experienced declining performance, with a decrease in percentage share from 2023 to 2025. In contrast, North America and Europe, Middle East and Africa, EMEA, regions maintained stable revenue shares during this period. Shopify's management outlook and strategy management at Shopify is optimistic about the company's future growth prospects. They expect continued expansion in merchant solutions revenue, driven by increased order volumes and Shopify Payments revenue during holiday seasons. This growth is expected to be seasonal, with the business becoming more cyclical due to the rise of merchant solutions offerings. To achieve this growth, management is focused on making strategic investments that expand expertise and build strong partnerships. These investments are a key part of their strategy and use of capital. The company also evaluates each investment to determine if it meets certain criteria for consolidation under the equity method. However, management is aware of potential risks that could impact the business. Inflation risk is a concern, as significant inflationary pressures on costs could harm the company's financial condition and results of operations. Additionally, future investment income may fall short of expectations due to changes in interest rates. To mitigate these risks, management has made strategic acquisitions, such as Vantage Discovery Inc., which will accelerate the development of AI-powered search across search APIs, shop and storefront search offerings. Overall, Shopify's management is committed to growing its merchant solutions revenue while managing inflation risk and making strategic investments to drive future growth. The company has made notable acquisitions and divestitures over time. In terms of acquisitions, one significant investment was made in Flexport Inc., as mentioned on page 80. This indicates a strategic move by the company to expand its reach or capabilities. On the other hand, there have been some divestitures. One example is the sale of a percentage of Shopify Capital loans and MCA receivables to third-party investors, which was previously done in the past, as mentioned on page 26. This suggests that the company has chosen to offload certain assets or liabilities to free up resources or reduce risk. The company's financial policies have been noteworthy in recent times. Notably, it has chosen not to pay out dividends to its shareholders. This decision suggests that the company is prioritizing reinvestment and growth over distributing profits to investors. On a separate note, the company has implemented a share buyback program, authorized to repurchase up to $2 billion of its Class A subordinate voting shares. This initiative demonstrates the company's commitment to maintaining a healthy capital structure and potentially boosting shareholder value through strategic share repurchases. Supply chain disruptions pose a significant threat. The extracted summaries reveal several concerns regarding supply chain disruptions. On page 12, global supply chain disruptions and shortages are highlighted as a major issue. This is further exacerbated by third-party suppliers violating laws or implementing unethical practices, as mentioned on page 18. Additionally, page 19 notes that supply chain disruptions can be caused by lower levels of consumer spending, currency exchange rates, and foreign exchange controls. These disruptions have the potential to impact distribution and sales, as noted on page 33. The possibility of litigation, loss of right to use open-source software, seasonal fluctuations in merchant solutions revenues, and foreign exchange rate fluctuations affecting operating expenses all contribute to a complex web of risks that could compromise supply chain stability. That concludes the financial summary for Shopify Inc. Feel free to comment below, and I will be happy to answer them when possible.